Basel III has had a huge impact on European banks. For the UK, I think we have something of a spectre called slotting, and the FCA, the regulator, has postponed the implementation of it on representation from its members, which are predominantly, in this case, banks. And I think there's a little bit of the opposite of turkeys for Christmas. They're just trying to promote their own opportunity to lend without too much restriction. And I really do worry that the FCA in the UK is missing a trick that the Basel III regulations would have otherwise covered. Instead, slotting would actually control a lot of the excesses that we're beginning to observe in the UK market.
So you call it slotting?
Slotting. It's a method of analysis of a loan portfolio with allocation of risk capital according to maturity or duration and risk.
I mean, one of the answers as well is, Basel III, especially with the liquidity ratios and net stable funding ratios, were clearly expected to have a big impact on banks and on the leveraging. And a year or 2 years ago, I mean, all traditional banks were trying to shift their model from the traditional lending model to the originate to distribute model. To be honest, I mean, we have not really witnessed such a big change in the way banks are behaving on the market, and we see more banks coming back, keeping most of the financing on their books and basically rebuild their books. So I think, as Anthony said, the Basel III effect will materialize at some point, but it has been postponed clearly, and banks are rebuilding their balance sheet, their profitability, and so therefore I guess there will be a deep change in the market in terms of who does what, and the market share, alternative lenders would constitute in the end, but it's going to take more time than expected initially.
I think it'd be quite interesting to see what the impact of the ECB at the moment is going through a process of getting the individual country central banks to review quite a lot of, I think there's over 100 banks in Europe that are currently having their loan books reviewed, and a process to make sure that they are, in effect, marking to market or closer to mark to market their positions. And I think the impact that could have into the market will be interesting to see. So it may take, in certain countries, some of the banks further out of the market because of their capital position as a consequence of the exercises being undertaken. So there's lots of moving pieces in this the regulatory side, but ultimately, yes, I think it is going to have a bigger impact on banking going further forward and lending generally.
I think you're absolutely right, Philip. The question I keep turning over in my mind is exactly what will be the impact, because at the moment we stand very much at a crossroads in the market. The banks could be coming back pretty substantially now, back to where they were, probably 2006, 2007. And what worries me is that the fledgling alternative debt fund market, and it really is fledgling, or if you prefer, it's still relatively nascent or embryonic, it could just get crushed out of existence. I think that's a desperately worrying potential, because, and someone said it earlier on, the US market is a 55% banking-led market, and the rest of it is alternate sources of funding. We need to try, and I've been saying this for a long time, we need to try and get there. And I'm all for the competition. As many debt funds as we can find should be launched and should be deploying capital. Because what worries me is that we end up retracing the steps that led us back to 2007, and the banks could end up again 85 and 90% of the total market. And I do think that's a very worrying situation. Postponing and delaying the implementation and the impact of regulatory controls, as blunt an instrument as they may be, is ultimately not a good decision.
I think what we have been seeing over the last couple of years is basically banks winding down their real estate portfolio. Now they need to live off something, so they start to lend money, and what's going on in Europe right now, especially in Germany, on the scrutinizing of these portfolios, I think that will be a wake-up call for some of the banks. I think that will push for some of the debt funds to get some space. It's a really pretty tough scrutinizing of the portfolios right now. And I think that will show them the risk or the result of Basel II when that has been implemented.
But I think you also got the Solvency II thing, which was sort of driving a lot of the institutions into the market, again, which is not coming forward as quickly as everybody thought it would, because that would have made it more attractive for the major institutions of Europe to start through their fixed income desks to allocate more, whether it's into a fund or like Aviva that just has a platform that is lending as part of their overall investment strategy.